Robotics technologies continues to improve, and with the rising cost of labor, more and more businesses are looking to robots to improve efficiency, cut costs, and increase profitability. Serve Robotics and Symbotic are benefiting from that trend. But which one is the better stock to buy for long-term investors? I'll answer that question in this video, comparing these two innovative technology companies on revenue growth, on profit, on cash flow, on valuation, and on what revenue growth looks like next year to determine which one of these robotic stocks I think is a better investment today. So let's get right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, when we look at revenue growth, there's a big difference here between these two robotics companies. Serve Robotics generated revenue growth of 655% in the latest quarter, a massive increase to be sure, while Symbotic generated 57% revenue growth in its latest quarter. These two companies are vastly different in terms of size. Symbotic generates billions in revenue, whereas Serve generates millions in revenue. But they have something similar in that they have a large strategic partner. With Serve Robotics, its main partner is Uber with the Uber Eats, as it uses that technology to deliver on orders on the Uber platform. Right now, Serve Robotics is only operating in Los Angeles. It's expanding within Los Angeles and around Los Angeles, but it has ambitions to go beyond that. Right now, it's only delivering food, and it also has ambitions to go beyond just delivering food. Symbotic, meanwhile, works with warehouses and improving warehouse facility operations, replacing some humans with robots, making each human more productive. The primary strategic partner for Symbotic is Walmart, as Walmart stands to benefit from using more robotics in its facilities. Walmart employs millions of people, and if it can reduce the headcount, it would do a great deal for improving its profitability. Each of these two robotics companies has excellent long-term prospects, with their innovative technologies coming just as labor expenses are increasing worldwide. Not just the cost of labor, but what's also troubling businesses is the availability of labor. Sometimes businesses just can't find people to fill roles that they need. And so they go without and they go short because there just isn't enough people to fill the kind of jobs that robots can do, or to fill the kind of jobs that businesses need, and the wages that they're able to offer doesn't really attract enough people. You might say, well, if they would pay more, they can attract more people, but if they pay more, then the business is not viable. So they need to find employees at the right price. Otherwise, that business is not viable, and they would just as well cut that line of business instead of hiring people at higher wages, which makes operations unprofitable. Now, these are very early stage companies, so profitability is not the priority for either of these companies. But what is a priority is reducing the cash outflow, reducing the losses on the bottom line. That way they have a longer runway to profitability, and that way they get easier access to credit. If you're hitting milestones and getting better and better on operations, reducing the losses on the bottom line, making progress, then when you go back to investors to ask for more money, it becomes easier to raise capital, and therefore it gives you a longer runway to continue growing without focusing so much on profitability. However, if you're going in the wrong direction, losing money and more so without hitting critical milestones, investors become impatient and they don't want to give you more money, or if they do give you more money, they charge you very high costs of capital. And so it hurts the business, it hurts the growth prospects of the business, and stunts their growth if they're not making progress. Thankfully, Symbotic has done a great job at improving profitability. It reduced the losses in the last year to $149 million, down from $240 million the year before. Serve Robotics didn't make that much progress, but at least it didn't get much worse. Negative $27 million. And Serve Robotics is in a much earlier stage of development than Symbotic, so we can forgive Serve Robotics for not making much progress on profitability. It's still trying to expand. It's still, it only has roughly 100 robots in operations. It's trying to add another 2,000 here in Los Angeles, but it's still, like I mentioned, just in one city, very early stage. So we can be a little more patient with Serve Robotics. Looking ahead, the analysts on Wall Street that are following Symbotic stock expect it will deliver revenue of $2.4 billion next year, which will be sales growth of 36% year over year. That will be slower than the 49% growth it's expected to achieve in 2024. Still, look at the difference in size with $2.4 billion revenue expected for Symbotic, whereas Serve Robotics is expected to generate just $16 million in revenue next year. But that will be a massive increase from the $1.7 million expected in 2024 for Serve Robotics. As I mentioned, the company is still in very early stages, and its growth runway is significantly, its growth rate will be significantly higher than Symbotic, at least for the very near term. Cash flow from operations is also important for the same reasons I discussed for operating profit. If a business like Serve and Symbotic can become cash flow positive, they give themselves very long timelines to continue developing their technology and increase the chances the business survives long enough to develop technology and grow into a large enough business to be self-sustaining and self-funding. Symbotic has done that. $50 million in cash flow from operations in its latest quarter, and they've generated several consecutive quarters of cash flow positive. That means Symbotic doesn't need to go back to investors and raise capital. They could, if they find opportunistic rates of borrowing or opportunistic cost of capital, they can go and raise more money to help fund future research and development for growth. But if the cost of capital is not favorable, they're not in a desperate position. They don't need to raise capital if they don't have to. Serve Robotics is not in that position. They are still negative in cash flow from operations, but they've been stable in terms of the cash flow from operations outflow. Negative $5.7 million in the latest quarter, and it's not worsening, it's stable. And given the expansion that's upcoming next year, with the revenue jumping up to $16 million, hopefully Serve Robotics can begin to approach cash flow neutral by the end of next year. They can start talking about when they will be cash flow neutral and what their plans are in terms of cash flow from operations or funding their future growth. Now, with companies like this, it's also important to look at the balance sheet, and I look at net long-term debt, which is long-term debt minus cash, and Serve Robotics is negative $28 million in terms of cash minus long-term debt. They have more debt than they have cash and short-term investments. Symbotic as well, and much worse. Symbotic is at negative $870 million in net long-term debt. But remember, Symbotic is a much larger company. So if you compare long-term debt to revenue, then Symbotic at $870 million is still not that bad because they're going to generate over $2 billion in revenue next year. So it's less than 1 times revenue. Whereas Serve Robotics at negative $28 million, even looking at next year's revenue, which is expected to jump significantly, they still have more long-term debt than next year's revenue. So on a percentage of revenue basis, Serve Robotics long-term debt is more of an issue than Symbotic's long-term debt. So balance sheet-wise, Symbotic has the edge here. And finally, I wanted to compare these two on valuation. Serve Robotics is trading at a forward price to sales of 25, where Symbotic is trading at a forward price to sales of 1. Now, Serve Robotics has much better revenue growth expectations, not only for next year, but several years ahead. Symbotic is not going to grow revenue as quickly as Serve Robotics. That being said, Symbotic is already cash flow positive and has done a great job in building out the business, already generating a couple of billion in revenue. And given that it's trading at a fraction of the valuation, if I were to pick between these two robotic stocks today, I would pick Symbotic. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.